Okay, good afternoon, viewers. We are going to resume our series on financial reporting, and as promised you that we are going to kick off with our IAS 16. We are going to be starting our standards, and the last video had looked at how we can be able to define the elements of financial statements as far as the revised conceptual framework of March 2018 are concerned. And we looked at how items are going to be measured, how we assign values to different assets and liabilities, and the other elements of financial statements. And we said we distinguish the financial statements from the elements of financial statements from the components. The components of financial statements, we say those are the mainly three: cash flows, balance sheet, and profit and loss, or the income statement or statement of comprehensive income. So that's how basically we went as far as they are concerned. We looked at the measurement basis. We said can be measured at cost, historical cost, current cost, realizable or settlement value, modified cost, present value, and others as we explained. So when we introduce this topic, this first standard of our financial reporting, that is IAS 16 property. IAS, when we talk about IAS, it is International Accounting Standard. So don't get scared when I talk about IAS, because most of you guys are used of the other financial accounting terms, but this is the general name that has been given to these assets as we are going to be looking at them: property, plant, and equipments, as we are going to be looking at them. But before I take you to any further, as far as, because when you see property, plant, and equipment, those are non-current assets. Let's first understand something before we start to go deeper into the PPE. I'm going to be abbreviating it with PPE. Hope you can be able to cooperate with me with that word. I want you to first understand that there are so many standards that are dealing with with assets, especially non-current assets. So when we are talking about these non-current assets, what I want you to make sure or be able to identify in whichever asset they are talking about in the question, be able to identify the nature of the asset, be able to identify the purpose of the asset. Those two items, they are very critical in determining which standard are you going to be using to account for any non-current asset that has been given to you. So when you are talking about these non-current assets, we have them in terms of the tangible assets and intangible assets. As far as the intangible assets are concerned, they have a separate standard that accounts for intangible assets, and that is IAS 38, intangible assets. But today our main focus, since we are talking about property, plant, and equipment, that is a tangible asset. The intangible ones, we know them: goodwill, trademarks, brand name, all that you know from there, or as we are going to learn them when we go to that standard of IAS 38. But I wanted you to get the concept. These non-current assets, they are supposed to be for more than one accounting period. I hope that one you know from financial accounting. If they are more than one accounting period is 12-month period. That's a 1 year. So we say they are grouped into the tangible and the intangible assets, and we said the intangible assets are accounted for under IAS 38. Then these tangible ones, you have also to identify. Don't forget the purpose. I said the purpose and the nature of the asset is very important in determining which type or which kind of standard you are going to use to account for that property or asset. If it is a current asset, it is accounted for under IAS 2. That is inventory. If it is inventory, if it's what we are going to be seeing them, but just know, as far as assets are concerned, they are categorically classified in different segments, and each segment has its own standard that handles it. So when we talk about these tangible assets, we have sorted the intangible. Hope you can't get confused from there. The tangible assets, you have also to know what is the nature of that tangible asset. Secondly, you have to know what is the purpose of that asset. If the organization has that asset, it uses that asset for what? The tangible assets, they are also grouped into two as far as their purposes are concerned. The tangible assets that are used in the organization, that they are used within the organization for production purposes or supply of goods and services, and to a smaller extent rental to others, to a smaller extent. Those are the ones that we group into PPE, property, plant and equipment, and that is the scope of where the IAS 16 stops. Then there are those assets that are held within the organization. They are tangible, but they are being given out mainly for earning rental income, or they are being set aside for capital accumulation. If, let's say, you have bought land, capital accumulation will mean you've left there for it to increase in value. If you buy land, let's say in a nearly developing area, and you leave it for 10 years, you'll find that if you buy it 10 million, you'll find in the next 5 years it will be around 50 million or 100 million, depending on the market conditions that are and the growing rate within that area. So if it is for market appreciation, if it is for rental, mainly rental to others to earn rental income, then those ones are grouped into investment assets, and those investment assets are treated under a different standard, and that is IAS 40, which handles those investment property, as we are going to be seeing when we look at that standard. Then for these assets that are used by the business, maybe in the production process to produce more goods, or to supply the goods and services. If the company is in services, it is used to maybe to deliver the service to other people, or to a smaller extent is used to earn rental. It does some production, and an example, you can use maybe a crane. If the company has a crane for lifting these heavy items within the factory, it can be used out to get some rental, then it comes back for business. We shall look at that when we specifically trying to separate. After understanding these PPE and investment property, you get to know which one is which one and which one falls in which side after handling those two concepts. But basically, PPE is mainly for non-current assets which are tangible in nature, and they are being used to generate income to the business. And generating that revenue we are talking about in terms of the income, we are talking about it is used in the day-to-day operations of the business. But there are other assets which are accounted for under different standards, like the biological assets. Those ones, they are not under PPE. They are also having their separate standard that handles them. There are these financial instruments, shares and bonds and all that other instruments as we know them. That's accounted for in another IFRS 9 standard. So this one, when you talk about PPE, before you read anything, just know it is mainly for those assets that are used to earn revenue in the business, and they are used in the production and supply of goods and services, or they are used for administrative purposes. It may be a building that has been constructed, but the company uses that building as its head office or branch or whatever. That's what we are talking about. It is mainly used by the organization to earn rental income, and it is going to be used for more than one accounting period. That's more than 1 year. That's how basically I can give you a brief review about the non-current assets. So having understood that, then let's push to this specific standard of IS 16, that is property, plant and equipment. And the other thing you may also need to know is that if a certain item is accounted for under different standard, it cannot be accounted for under another standard at the same time. Each item is treated differently depending on where it belongs. So please take note of that. So we can try to look at certain, before we reach to the main issue, we can look at what are some of the terminologies that are used within these standards. We can talk about the cost, and we said in the other previous video, we said that the cost is the actual expenditure you have incurred to acquire the asset. But this one we are mainly talking about assets, so you are not going to hear me talking about liabilities. Here we are talking about assets. The actual cost you've incurred or expenditure you've incurred to acquire the asset, that's what we call cost, as far as this is concerned. Then we have a residual value. A residual value is something that remains at the end of the useful life of the asset. What you can get from that, it is called a scrap value previously in your accounting, but here we call it residual value, and it's what remains at the end of the useful life of the asset. Then we can talk about the useful life of the asset. That is the lifespan of the asset. If you buy the asset has to be there for a certain period of time. It is not like land that doesn't depreciate in value, that it will be there for forever. This one has a useful life. You may buy it, and even if the asset doesn't get spoiled, you may find that it becomes outdated. It cannot be worked anymore, be used for making work. You can talk about the computers. We have iCore 3, iCore what, Pentium what. Those ones that they are already outdated. Even if you still have it, but there are certain things which you can't do with them, even if you want to. So at the end of the day, we give it a useful life. Factors you depend on to determine the useful life those ones you can read on your own, but maybe to give you a few, you can say that this asset, according to the activities, I put it in. If let's say it is a laptop, you put it in office all the time. You don't carry it to, let's say, in the field and all that. It cannot get like spoiled very fast. You can give it some useful life. So that's basically what I can talk about, the useful life of the asset. Secondly, we can talk about the value in use, or the entity specific value. The entity specific value, or the value in use, it's what we are expecting to get from the asset we have acquired. If let's say it is PPE, an item of PPE, and we have acquired it, what are we expecting to get for the period it is going to be with us? Those are the ones we look at, and we put in the time value for money. We try to look at the timing of those inflows. How are they coming? Then we try to discount them to make them present. So we are going to be looking at most of those things. Then the other one, we can talk about the carrying amount. The carrying amount, most of you are used about the net book value, but that's basically the same. It is cost minus the accumulated depreciation and the accumulated impairment losses. Impairment losses, we shall talk about it. It's also a different standard, but what I can tell you is that impairment is just the loss in value. We have bought the asset today at 10 million, but in 2 years' time, it's the amount you can get from it is, let's say, 2 million. That's basically impairment. That difference is what we call impairment. So that's basically what I can briefly describe before we dive into the specifics of the standard, because here the notes I made, they are not very broad. I picked the things that you need for you to pass the exam. So before we conclude with all this, we can talk about certain items that we are going to be following. We have to define what PPE is. We get the recognition, measurement, as we looked at them in the previous video. Those are the ones we are going to be looking at, and we see how we can be able to appreciate all that. How are we doing the initial measurement at acquisition data? What are we doing then? As we are going to look at them. So definition wise, property, plant and equipment refers to tangible assets. So that's the nature. The nature, they are tangible assets held by an entity for use in the production or supply of goods and services. Now the use comes in. It is used in the production or supply of goods and services, or for rental to others, but this rental to others is to a smaller extent. Most of the times it is used within the production, but once in a while it is being given out to earn some small rental income, or it is used for administrative purposes. We have constructed our house, and we have made that house to be our head office, period. That's administrative purposes, and are held for more than one accounting period. We said the other tangible assets held by any entity for use in the production or supply of goods and services, or for rental to others to a smaller extent, or for administrative purposes, and are held for more than one accounting period. So we'll try to look at the recognition. Recognition, basically we are just looking at how are we incorporating the PPE into our financial statements. What are the conditions that we are supposed to fulfill before we record any item of PPE into our financials? I said when I talk about financial statements, we mean the balance sheet, income statement, and the cash flows, basically. but there are other consolidated ones and whatever, as we are going to be looking at them in the due course. But we have certain criterias. If let's say we are saying we are supposed to include the PPE into our financials, then what will be the criteria for us to, or what are some of the conditions that we are supposed to fulfill before we say that we have an item of PPE? One, we are saying it's probable that future economic benefits associated with the asset will flow to the entity. I put them in blue because they are very important. It's probable that future economic benefits associated with the asset will flow to the entity. If you have any item, even if it is item, it is a tangible asset and it is used in the production, but it doesn't generate any income, it's not part, because it doesn't satisfy the recognition criteria. Then the other criteria is that the cost of the asset can be measured reliably. If you can't determine the cost of that PPE, then what are you going to put in which figure are you going to be recognizing? Remember, when you are preparing financial statements from our financial accounting, is that we only record monetary items, items that can be attached a value. Those are the ones we incorporate in our financial statements. So that's basically, there are two scenarios. If you satisfy those ones, then you recognize those assets. But upon recognition of those assets, then that we have decided that this asset is going to bring us something to the entity, or some money, some cash flows to the entity, and its cost we can determine it. Then which cost are we going to assign to that item? That's what we are going to be looking at in the next slide. That is the measurement. We are going to be looking at the measurement of PPE, property, plant and equipment. I said I'm going to be using PPE. Hope you can be able to cooperate with me. And we are saying that we have two measurement criterias. These measurement criterias, they are very important because they tell us which base or measurement base are we going to use to recognize these assets. And we are saying that PPE, we have the initial measurement, and we are saying the initial measurement is the measurement at the acquisition, when you are just acquiring the asset. What figure are you recording in the statements? That figure you are recording is what we call the cost at the initial, that is the initial measurement. And we are saying this is the cost at, this is the time at the time of the acquisition of the asset. And the standard says that PPE is initially measured at cost. We measure items of PPE at cost initially when you have just acquired them. Of course, that's obvious. When you acquire any asset, the amount you have paid to acquire that asset is actually what we are going to be recording, because we are not going to be having any information that we are going to record. It's only that amount that we are going to be recording in our financials. But when we talk about cost, the word cost is very broad. It doesn't necessarily mean that it is only the purchase price of the asset. There are other costs that are supposed to be capitalized, if I can call it that way. There are other costs that are supposed to be added to the asset. If, let's say, can I give you a short example? If you buy inventory, and if, let's say, the cost of the stock is 10 million, and you are incurring transport cost of 2 million, that transport cost of 2 million is supposed to be part of the cost of the stock. because we are looking at what are the expenses you have incurred to bringing that those assets you are purchasing to their useful state. Actually, that's what we are supposed to incorporate in the cost. If you are purchasing the item from abroad and you're bringing that item to Uganda, and let's say it's supposed to be starting operating at any given date in time, then the cost of purchasing that item is inclusive within the cost. Even the transport we are incurring from overseas to Uganda, where the item is going to be operating from, those costs we are supposed to accumulate them or we capitalize them to get the total cost we've incurred. Then there are also other costs. If the asset reaches here, it doesn't mean that that asset is going to start functioning. An example, if let's say you buy a new laptop, you may find that the software which is there is you may need someone to at least to reoperate the machine so that you can be able to use it. If let's say you are buying a car, and you may find that you'll get a mechanic who can just try to drive in and see what is missing within the asset and how the asset is operating. So those costs you are incurring to that person, they are supposed to be capitalized or they are supposed to be included within the total cost. So basically what I'm talking about is that we are incurring those costs that are inevitable, and when we don't incur them, the asset is not going to operate. We are supposed to capitalize them and we add them to the price we've paid to acquire those goods, and we'll be able to get the total initial cost. I've highlighted some of them, but there are very many items that are associated with the asset. But what you have to understand is that if you see that asset, if that cost is not incurred, the asset will not operate. That cost is supposed to be essential, or is supposed to be a relevant cash flow which is supposed to be added back. That's basically how we can differentiate them. What we are saying, we are going to be looking at the components of the initial cost. Initial cost, we have the purchase price, that is the price you are paying for the item. But remember, there are certain instances where you are going to be paying the asset, to be purchasing the asset, but they give you a discount. If you are purchasing the asset, the cost of the asset is 11 million, but someone says pay 10 million, and you take the asset. If at all you are paying all of the money, that discount you are receiving is supposed to be less, because obviously it's not supposed to be included, because that's not what you actually paid. The purchase price was supposed to be 11 million, but you actually paid 10 million and they gave you the asset, and they are not demanding you. So it means we are recording the 10 million, not the 11 million. If there are other rebates, you may purchase the items and they say you pay 11 million, but after taking the item, after paying all the money, we are going to refund you back the 1 million. Those rebates, you less them. Meaning what we are taking is the net purchase. Net purchase means we have raised the discounts. So on that price, because that's actually what you have paid. But remember, where you are purchasing those items is not that person to incur the rest of the cost until the asset is at your premises. You are going to incur. They give you the asset and you see how you can import it, if at all it has been from overseas. You find that there are other import duties and other non-refundable taxes, mainly direct taxes, which are incurred when you are, let's say, importing the item from overseas. That one is supposed to be part of the asset. They are either import or direct taxes. Then the other one is we are supposed to incorporate in any cost we've incurred, but it is directly attributed to the asset in its useful life. If you are incurring that cost, but that cost is directly related to the acquisition of that asset or bringing that asset into its useful state, then it's supposed to be, because if at all you're acquiring an asset and it is not going to function, then it doesn't make any sense for you not to incurring other costs so that the asset can start operating. So these other costs that are directly attributable to the operation of the asset, they are very many, but they are going to be very tricky, but I've highlighted some of them. We have the site preparation, installation, testing. Then we have the professional fees, like if it is a land, you're going to get some documentation and all that. So you may need lawyers and whatever, accountants, or all depending on the item you're purchasing. Then this last one, the initial estimates of the dismantling asset and restoring the site. That one is a bit separate. It is not very tricky, but the tricky one is getting those costs that we've incurred, but they are directly attributed to the operation of the asset. So when you have known that, then we have this last one, the initial. This initial one is the one that is not very tricky. Of course, someone can be able to remember this, but this initial estimate cost is that if, let's say, you've been operating, let's talk about these people who are doing the mining operations. After you have been given the mining area or the contract area for that, where you are going to do your either mining or drilling oil or that petroleum and whatever. So the cost you are incurring, because when you are going to be doing mining, you are going to be digging underground to be able to look for those minerals you have explored. So these costs you are going to incur in the future if all the operation, your contract is done and you have got whatever you had paid for, but the land is still like you have disorganized the land, then the cost of maintaining the land to the state that is exactly how we found it before starting your mining activities is what we call that cost you are going to incur in the future, but it is relating to the maintaining of the environment. If, let's say, you are disorganized the environment and you are going to make sure you reorganize the way you found that surface. If you are in mining, that cost we are going to incur, we are supposed to incorporate that cost into the initial cost, because that cost is going to be, at the end of the day, you are going to pay it, even if it is going to be paid in the future. But we try to discount it, we bring in the time value of money, we look at what will be the present worth of that cost. Make sure when you are getting this item, if you find it in the question, you discount it because it is going to be in the future. You are not going to incur that cost now. You are incurring that cost in the future. So if you are to incur that cost in the future, but you are accounting for it now, you have to discount it and you get its present worth. After getting its present worth, then you can be able to incorporate it into the total initial cost. So when you get all that and you add them up, you will be able to get the total initial cost. That's what we are going to be using to initially record our PPE. Hope you can be able to get that, and we can proceed. Of course, we said for initial measurement, we measure them at cost, but we've seen all the components that we are supposed to be included, in our cost. So we can look at the first one, which was the initial measurement, that is at the time of acquisition. Then we can look at subsequent measurement, and this subsequent measurement is the reporting date, or at the end of the year. What figure are you going to take? Are you still going to maintain the cost, or you are going to use a different figure? We said in our first video on this financial reporting that there are other measurement bases that we use. So if you have recognized the asset initially and you have recognized the PPE at cost, then what will be the subsequent measurement, or at the date of reporting? You have acquired the asset, let's say today, but when the year ends, which asset are you going, which value are you going to assign to that asset? Because remember, there are some items of depreciation and impairment losses. So there are two. When you are looking at the subsequent measurement, or at the reporting date, or at the end of the year, there are two models that we use to account for PPE at subsequent, or at the end of the year. So we are saying that, one, we can account for those assets at using cost model. A cost model is more of using the historical cost. Is more of a historical cost, whereby these items of PPE, they are carried at cost, less accumulated depreciation and accumulated impairment losses. Because if you have bought the asset, let's say on 1st January 2022, by the end of 31st December 2022, that asset will, we assume that it is going to be reducing the value in terms of this depreciation and the impairment that may happen along the way, because you don't know what will happen. Depreciating these assets is more or less of spreading the cost of the asset to its useful life. If you are spreading the cost of that asset to its useful life, it means every year it is going to be reducing in value. That's basically what cost model is all about. We carry those items of PPE at cost, less accumulated depreciation and accumulated impairment loss. We said impairment loss is just a reduction in the value of the asset, but we are going to look at it in details as we proceed. Then the second module is about the revaluation. It is a revaluation model. Evaluation, we said it is the estimated marketing price. We get what will be recovered from the asset at the point of revaluation. If at least, if let's say you bought the asset at 10 million and now you take it to the market, or you go for revaluation, and you find that the asset which was bought at 10 million, it has reduced either to 8 million or it has increased to 10 million to 15 million, you get either a loss or a gain on revaluation, as we are going to be looking at them. But here we are saying that the items, if you are going to be using the revaluation model, we are saying the assets are carried at the revalued amount less any subsequent accumulated depreciation and the subsequent accumulated impairment losses. So when you less those ones, you are able to get the carrying amount using the revaluation model. So when you carry these assets at using the revaluation model, we are going to be requested to make or to determine the depreciation of that revalued asset, because the asset, if this asset was initially bought at, let's say, 10 million and it is now at 15 million, the depreciation is going to be different. The depreciation of the cost that has been revalued at 15 million is different from that of 10 million, which was the cost. And even the useful life of the asset that was acquired at cost is different to that useful life of the revaluation, because after revaluation comes after you have already purchased the item and it has been there for some time. So you may have to redefine what will be the useful life, because by the time you go for revaluation, you will first of all know the cost, its estimated market cost, and you will also know what is the estimated useful life, the remaining useful life of the asset. Those are the two things we revalue. We revalue the cost, the item, and we revalue also its remaining useful life. You may find it doesn't mean that if you bought the asset at 10 million and you estimated that its useful life will be 10 years. It may happen that at the point of revaluation, you may find that you had expected, if let's say you do the revaluation at, let's say, after 3 years, and in the normal case it would have remained with the 7 years, but you may find when you do the revaluation, you may find that the asset can even last for more than 10 years. Of course, you will be having a different depreciation, so we need to determine the depreciation of the revalued asset. And we are saying, when we are determining, it is the same formula of determining, the usual way we determine the depreciation, but only that here we are using the remaining useful life. We are not using the old useful life of the asset, but we are using the revalued useful life of the asset. It is the revalued amount minus the residual value over the remaining useful life. There is a scenario which happens that the depreciation you created at initially will be different from that of the depreciation that you have got after revaluation, which will give rise to either excess. You may find that the depreciation is high or it is low, and we shall see how we can be able to treat those ones. Okay, let's try to look at the items of revaluation, and we try to look at how we can be able to account for the revaluation gains and losses. We said that when you are doing the revaluation, the asset is either going to be having a higher value compared to what it had before, and it may be more or less the other side, or it may be less than what its carrying amount is at the time of revaluation. So it may create either a revaluation gain or a revaluation loss. So let's try to look at how are we accounting for those revaluation losses and gains. We are saying accounting for revaluation or revaluation gains or losses. We are saying that when an asset is revalued, there will be a gain or loss on revaluation, and we are saying to get the gain or loss, we get the valued amount less the carrying amount. We say the carrying amount, it is the net book value of the asset at the reporting date or at the time of revaluation. What will be the carrying amount of the asset at the time of revaluation? Remember, this asset we are revaluing, we bought it sometime. So by the time we bought it, we estimated the useful life, we estimated the cost. So we also determined its depreciation. So when we revalue the asset, we first of all, by the time it took us to do the revaluation, there are some depreciation which has been accumulated. So you get that cost minus the accumulated depreciation to get our carrying amount. That's how we get the carrying amount, which we are going to be using to compare with the revalued amount. We see whether there is a gain or a loss on revaluation. So how do we account for a revaluation gain? We are saying that revaluation gain, this arises when the revalued amount exceeds the previous carrying amount or net book value of the asset. We said if we revalue upwards, it means there is a gain. That gain comes after comparing the revalued amount and the previous carrying amount, not the cost of the asset. It is carrying amount. Because by the time we do the revaluation, there is depreciation which has already occurred. As we said from initial measurement, we say the initial measurement, we measure them at cost, but subsequently we less the accumulated depreciation and the impairment losses that may happen. So when there is a revaluation gain, we say that we take that. Remember, these revaluation gains and these revaluation losses, they are not actually realized. In actual sense, we have not actually incurred those losses, but it's just that we've revalued the asset and we've got a more or less a high figure, but we have not actually sold the asset. The asset is still with us, but what we only did is to get its current market value. So since they are unrealized, we don't take them to the income statement or profit and loss account, but we take them to OCI, that is other comprehensive income. The other person may say that we create a revaluation surplus. At the end of the day, that revaluation surplus is supposed to be taken to the balance sheet under equity section. That revaluation surplus. Remember, in the normal business transactions, revaluation gains and revaluation losses, they are not supposed to be taken to the profit and loss because they are not actually realized, they are not actually real. We've just made them. So let's try to first look at the revaluation again, then I will explain that component later, how we treat those things. We said the revaluation gain happens if the revalued amount is higher than the carrying amount. It means the assets are now increasing in value. And we said when the assets are increasing in value, that's income. That's why here we are crediting the OCI, that is the other comprehensive income. Then the entries, the double entry will be we debit our PPE or our land or building, whatever item it is, because it is increasing in value. So if it is reducing in the value, let me first handle the revaluation loss before I go to this NB. There is a simulation. Let me first talk about the accounting for revaluation losses. These losses, they arise as a result of the carrying amount being more than the revalued amount, or where the revalued amount is less than the carrying amount. From there, we have a revaluation loss. But this revaluation loss, we can't create a revaluation loss account, no. But we take that item to the profit and loss. It's like when we take that item to profit and loss as an expense. In the normal business, we are saying that is not how it's supposed to be. But if we are doing the revaluation for the first time, and we have the assets are reducing, we have a revaluation loss, we don't create a revaluation loss account. If it is for the first time of evaluation and you have a loss, we don't create it. What we only do, we take it to the income statement. By taking it to the income statement, it means, remember, the revaluation surplus is taken to other comprehensive income, or we can take it direct to the equity. But this one, when you include it in the profit and loss as an expense, it means it's going to reduce even the equity. How is it going to reduce the equity? Because the net profit we are going to be carrying to the equity section is going to be less by that figure. What that means is that when we do other revaluations in the preceding revaluation and we get a gain, if at all we had made a loss, if let's say we have made a loss today and we have done our revaluation and we've made a loss and we've taken that to the profit and loss, it means we have understated our equity section in terms of the net profit we've taken there, because it is less by that amount of the loss. So if we do another revaluation and we find that in this time we have a revaluation gain coming in, what happens is that if it is not if it is the second time, when you have the first time we had a revaluation loss, but the second time we are having a revaluation gain, it means that revaluation gain we've got from that second revaluation is supposed to first offset the previous revaluation loss we incurred, because in the normal course of business that revaluation loss is not supposed to be taken to the profit and loss account because it is not actually realized. That is the implication. So what we do, if today we have got a loss of 10 million and the next revaluation we get a revaluation gain of 15 million, what happens is that we first of all get that revaluation gain of 15 million. We first remove the 10 million to offset the other revaluation loss we took to the income statement. How do we do that? We credit the income statement. By crediting income statement with the same 10 million, it means you are removing the other figure you included last time. Because by this time you are recording it not as an expense but as an income by crediting the income statement. Remember, we had debited it with the loss. But here you debit it with the reversal of the loss. But now what will happen is that the asset will have, if on the second evaluation it had the whole 15, we shall increase the asset by that 15 million. Because remember, by all means, what you are taking to the balance sheet must be the revalued amount, not the carrying amount, the previous carrying amount. So we shall increase the asset account by 15 million, but we'll credit profit and loss in regards for reversal of the revaluation loss of 10 million. Then the balance of 5 million is what we shall be taken to the OCI as the 5 million. So this 5 million, we will be crediting the OCI with the 5 million. We'll credit profit and loss. So it is even the reverse is true for the other. If at all in the first year you had got a gain, but in the preceding revaluation you are getting a loss, that loss first is supposed to reduce the gain we got previously, and the balance is what we shall take to the profit and loss. Hope you can be able to get that. That's what this NB was all about. This is how this, however, is talking about what I have actually explained. And this NB, that's what it was talking about. Here we are saying that NB, the revaluation gain, will however be taken to the profit and loss to the extent that it reverses a previous revaluation loss. Remember we said the revaluation gain, they are not supposed to be taken to the profit and loss. They only go there when they are reversing the loss that we took there. And any balance is what will be taken to the profit, to the statement of other comprehensive income. Other person can say the balance will be taken to the revaluation surplus. But all it means the same thing, so long as you get the concept. That's why here you are saying we credit the OCI with other, that is the other comprehensive income, the balance, meaning the balance. Then we credit the profit and loss account by the previous revaluation loss. Then you have to debit the asset. This one is will be having the whole revaluation gain because the assets will be increasing in value. It is the same thing which is here. That if previously, this one says, however, the loss will be taken to the OCI. Remember, this loss is not supposed to be in the OCI. It's supposed to be in the income statement. But it will only be taken there to the extent that it reverses the previous gain, and any balance will be taken to the profit and loss account as a loss or as an expense. That's why here we are saying we are debiting the OCI. Remember, this OCI is not supposed to be debited. It is only debited because this is income, other comprehensive income. It is only debited when we are reversing the loss we incurred. Then we of course we credit the PPE because it is falling in value. Then we debit the balance is what we shall be taking to the profit and loss. So I have a simulation here. There is a simulation which I was just jumping here, but I needed to first explain that before we do that simulation. There is a simulation on revaluation, accounting for revaluation gains and losses. I gave you these figures. There are two simulations. And this one is another simulation. Okay, let me first explain this before we do any computation. We said that this excess depreciation, how I talked about this excess depreciation, they arise as a result of the first, remember we said these elements of PPE, they are initially measured at cost, and they are subsequently, or they are reported when you have deducted the accumulated depreciation and accumulated impairment losses. But what will happen is that there is that depreciation that happens before you revalue. You may find that the depreciation before revaluation was 10 million, and after revaluing, because the figures, the revaluation amount has changed from what we had before, it means even the useful life has changed. It means we are going to be having a revaluation that is a bit high or low, depending on the figure we've got. But if we get it when it is high, then that excess depreciation is supposed to be treated as an income, and it is taken to the retained earnings. We are saying that this arises when the depreciation after revaluation is higher than the depreciation before revaluation, before revaluing the asset. For example, depreciation before revaluation of 10 million and depreciation after revaluation of 15 million, then we have excess depreciation of 5 million. And we are saying an entity may, this is optional, you may do it that way or you may leave it, because at the end of the day, we are accounted for those revaluation losses and gains. So this is optional. And we are saying the entity may make a transfer of the excess depreciation from the revaluation reserve to the retained earnings. That's what I told you, that's what I've been talking about, that revaluation surplus is taken to the equity component. In the names of retained earnings, you may put it under retained earnings, or you take it direct as a retained revaluation reserve. But it's mainly recorded within, because since it is from within the normal operations, it's supposed to be taken as retained earnings. So that's how basically we can talk about this PPE. I hope you've got a clear picture on what we cover under that. So the next slide is all about these simulations, which I've just skipped because it's now seems to be time. But in the next video we are going to be talking about an illustration. We'll do all those computations and we'll be able to understand each and everything. So thank you for watching. I urge you guys to subscribe and be able to click the notification icon so that you'll be able to get whichever video I'm going to be posting, and you'll be able to learn, because this is a foundation of accounting, mainly accounting and finance, where we are able to learn everything at our own pace. So let's meet in the next video. Thank you.